Generally, investors in equity markets are driven by emotions of greed and fear, which means that the investors add more into equities at high levels and sell at lower levels. But what is a rational investor expectation, or what should the rational investor do, is exactly the opposite of that, which means one should ideally buy more at low levels and sell at high levels. So, our fund tries to achieve that for the investor by buying when the markets are low, increasing equity allocations based on our price to earning multiple model when the markets are low, and reducing our equity exposure as the market PE multiple goes up. So, I think that's something is what helps investor to beat market volatility and not worry about timing while investing in the fund. The Aditya Birla Sun Life Balanced Advantage Fund invests into equity markets based on the price to earning model that it uses. Historically, we have seen that market gives high returns when the trailing PE multiple of the market is low. For example, historically we have seen for Nifty 50 index, when the trailing PE multiple is below 14, the average 3-year forward returns are around 37% annualized for the next 3 years if the trailing PE multiple is below 14. Similarly, when the trailing PE multiple for the index is high, around 25 PE multiple, then the next 3 years earnings actually are just about 8% annualized for the next 3 years. That's what the historical data tells us. What our model does is that when the PE multiple of the index is lower, 14 times or below, then the net equity allocation as per the model is very high at 80 to 100%. As the PE multiple goes up, the net equity allocation goes down based on the model. And when the PE multiple reaches 25, the net equity allocation drops to 0 to 40% range. So that's how the model works, allocating more into equity markets when the PE multiples are cheap and allocating less when the PE multiples are expensive. So the case in point is January 2018, where the market multiples were really expensive. The trailing PE multiple of the index was 28 times, and the markets had done really well over the last few years. That point of time, the model suggested the net equity exposure to be brought down significantly, and our net equity exposure at that point of time reduced to around 35%, post which we all know calendar year 2018 markets corrected dramatically, and the lower net equity exposure helped the portfolio do well. Similarly, in March of 2020, when the markets fell because of the COVID pandemic, the trailing PE multiple of the index also fell and went below 15 PE multiple. That point of time, we increased our net equity exposure to as high as 80%, because that's how the model works, and that's where we were able to take the advantage of fall in market levels because of the pandemic. If you look at the history of the fund has always fallen less than the market when the markets have corrected. For example, the maximum drawdown of the portfolio has been 26%, while that for the benchmark has been 38%. So as one can see in this chart, the green line is how the fund has performed, while the red line is how the market has performed. One can see that the green line has always fallen much lower than the market during the market correction phases. The sectors that we are bullish on include banking and financial services, predominantly private sector banks, followed by IT services, followed by consumers. And these are the three segments of the market we are very positive. Private sector banks, we believe, should do well over the next few years on the back of very strong asset quality and also very strong NIM performance because of lower cost CASA available to them in these rising interest rate scenarios. Coming to IT services has seen a fall over the last few months, and we believe the risk reward has turned favorable for IT services. And again, business visibility on the back of large transformation deals looks really strong. Lastly, consumer category again is something we have always known. Consumers are very resilient, and they are able to pass on any inflation to their customers in time, thereby protecting the margins. Therefore, we believe in these scenarios of high interest rates and inflation, consumers will be able to protect the downside and report decent numbers. Sectors that we are underweight on include pharmaceuticals, PSU banks. These are the two sectors that we are underweight on, where we believe the medium term outlook for earnings growth is muted. The near term market outlook is not so positive, considering high inflation, interest rates, negative sentiment in terms of FII flows. From that perspective, the net equity exposure is on a lower side. But from a medium to long term perspective, we are cautiously optimistic on the markets. This fund is a great fit for investors who do not want to time the market, because it is dynamically managed, which means that asset allocation between equity and debt is dynamically managed. As the markets go down, the net equity goes up, and vice versa. And therefore, an investor who is looking at long-term investment into markets and doesn't want to worry about asset allocation, for him this is an ideal product. I think this is a category which will suit the investor.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.